Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. This is the weekend edition where we interview notable people from the world of real estate investing. Today's no exception. We have an amazing guest. Today is part two of a conversation that we started last week with Russell Gray, co-host of the Real Estate Guys radio show. It's such an amazing conversation. If you haven't listened to last week's show, you probably want to go listen to part one first before listening to today's show. You're going to learn a ton about the economy, about how real assets work. You definitely want to hear the words of wisdom from Russell Gray. Here we go. We're picking up the conversation where Russ is talking about the U.S. dollar being the global reserve currency and what could happen if the U.S. dollar loses that global reserve currency status.
Gold right now is at all-time highs against every currency in the world except the dollar, and it's flirting with it. The inverse of that statement is that currencies are at all-time lows against money, and I think it's only going to get worse. And so if you're earning, have debt, if you denominate your net worth, if you think of things in terms of fiat currency, Canadian dollars or US dollars, but especially US dollars, and you're not ready for the impact of the US dollar, if the US dollar loses that reserve currency status, then you could get really, really wrong-footed if that ends up happening.
Well, the one thing that's protecting the reserve currency status is the petrodollar. It was the deal that was stuck between Henry Kissinger and Saudi Arabia post the Arab oil embargo in the mid-1970s, where Henry Kissinger said, if you agree that OPEC will trade forever in dollars, then it doesn't matter if Italy's buying oil from Nigeria. That's got to be transacted in U.S. dollars, even though the U.S. is not a party to the transaction. As long as that happens, the U.S. will protect the political, military, and sovereignty of the Saudi royal family forever. That was the deal. Right now, we're starting to see cracks in that. We're starting to see Russia and Saudi Arabia playing together. We're starting to see China and Saudi Arabia playing together. That could be destabilized. It's possible.
Yeah, it's more than possible. I mean, you saw the presentation at Future of Money and Wealth a couple of years ago. And in 2013, I think I did a presentation at the New Orleans Investment Conference called Real Asset Investing. In fact, I wrote a follow-up report. It's in our special reports library, and it chronicles. And here's what happened. We had the 2008 financial crisis, and the Fed's response was to print money. We had what then was the unprecedented giant Hank Paulson's bazooka, the $800 billion bailout, which of course looks like pocket change compared to what they're doing today. But that was the big thing, right? And he goes, hey, we're not going to use it. I just need to be authorized to use it. Sometimes just walking around the neighborhood with a bazooka is enough to keep things under control. That was Hank Paulson's, who's the Secretary of the Treasury at the time. That was his whole thesis. Well, so China is sitting there holding gobs and gobs and gobs of U.S. treasuries denominated in U.S. dollars. So in 2009, they come over here and publicly chastise Barack Obama about the debt and about dollar policy. And of course, we went and printed tons of money. The balance sheet of the Fed went from $800 billion to $4.5 trillion. And that started with Bush and really built under Obama. And so China, the very next year, got in bed with Russia. Russia at the time and for quite some time has been number one or number two top oil producer in the world. That first oil crisis that we had that everybody said was the Saudis going after American shale oil, I think it was the oil cartel, and the United States was probably involved in it, weakening Russia. But Russians know how to be poor. They know how to suck it up. That's a tough country. And what they did is they, over time, ultimately divested themselves of all of their treasuries and passed, I believe, China, at least as far as the official count, to number 4 position in terms of gold. So they have a lot of gold relative to other countries. If you buy into the United States' official count, we're still the top dog. People who follow that tend to think that China probably really is. They're just not telling the truth. But at any rate, Russia and China have been working together, and over the last 13 years, 10 years, have been more and more vociferous about leading the charge with bilateral trade agreements, the introduction of the Shanghai Gold Exchange as an alternative to the LBMA, the Asian Infrastructure Bank as an alternative to the IMF and the World Bank. What else did they do? China, the big deal was Navy, the U.S. Navy. Hey, I heard Dennis Gartman speak one time, and he goes, the dollar is protected by 14 aircraft carriers. Nobody else is even close. Okay. But China has been working on that. And, when you think about the components of what it takes to be a dominant force and how the U.S. was able to get into the position of taking the world's reserve currency away from Britain and holding on to it and developing it, they did it with the petrodollar, which you mentioned, and now there's the petro yuan, and those contracts are not directly, but through a process are exchangeable for gold. So there's the petro yuan. By having a bunch of gold, by having a big manufacturing economy, by having a deep and rich bond market, and China went into debt, added $33 trillion to their debt from 2008 until now. And was one of the big driving forces to pull the global economy out of recession. I don't know how many people know that. They started 2008, the recession, at $7 trillion in debt, China did, and they finished at 40. They added 33 trillion in debt. And of course, Australia was a big beneficiary of that. I don't know if we got any Aussies on here, but Australian real estate went through the roof. Why? Because China just bought all kinds of commodities from them. They went on that big building boom. All kinds of suppliers from the United States made money selling things to China. And so all of those components China had, and the things that they didn't have that the United States had, which was strong resources, strong agriculture, they went out in the world and bought or lent against. And that was the other thing that they did. They started making international loans denominated in yuan, which forced people, the same way legal tender laws force people to earn whatever the currency of taxation is to be able to pay the tax. That's what gives the dollar in the United States demand. Part of it is taxing. Part of it is there's so many US dollar denominated bonds out there, people have to go earn dollars to debt service. Part of it is oil. Well, China is just a giant copycat. And they looked at what the United States did, and they've been copying it. The one area they were weak is military and military tech. But guess who has that? Russia. So if Russia and China get together to take down the dollar, and they announced that they were going to do that and working on that in 2010, and I've got article after article after article for years chronicling it. I'm not saying that's what's behind this. I mean, the virus started in China. That's probably just a coincidence. But be that as it may, that has been my concern way before there was a coronavirus. Way before there was a coronavirus. It was that the United States was vulnerable to losing its reserve currency status. And when that happens, all of those excess dollars that the world is holding in reserves are no longer needed. It's like when a stock gets delisted on the S&P and all the fund managers go, oh, don't need that one anymore. Boom, right? And that means that falling dollar means rising prices. So it's probably going to be economic deflation because we've just had a heart attack and cash isn't flowing. So prices fall, mostly asset prices, because that's where all the inflation has been. And then hyperinflation, because we have disruptions of production, which means lower supply, people with lots of money, but nothing to buy, empty store shelves, bid goes up. I mean, so Americans I just don't think are ready. Now, I hope I'm wrong. For Joe Sixpack out there who has no idea that any of this has happened, wouldn't recognize a piece of gold if it hit him in the forehead, right? I hope I'm wrong. But I've been watching this for 10 years, and I'm pretty sure paper currency is going to begin to fail, and things that are real are going to be where you want to be. Precious metals, as far as savings, real estate, and productive income producing assets in terms of investment.
So let's maybe talk a little bit about inflation. You touched on it. You touched on hyperinflation. We'll also talk in a moment about stagflation. But for a lot of folks, maybe believe that inflation is the rising of prices. That's not actually inflation. That's the symptom. Take us through the way inflation really works.
I mean, it's pretty simple. When you increase the bid, which is what giving everybody more money does, in excess of the supply, then the bid is going to drive up the price. I mean, anybody knows that. If I put a piece of property on the market and there's one bidder, I'm not going to get as good a price as if there's 100 bidders, right? And if we introduce debt, meaning we can pull dollars from the future into the present by either lowering interest rates or raising LTVs or lowering underwriting guidelines so more people can come to the party, I'm adding purchasing power in terms of dollar volume to the bid, and prices go up. Well, it's the same thing. If you and I and 5 other people or 10 other people, let's just use 10 people. If the 10 of us are, the economy and we're all dying of thirst and there's one water bottle and all of us have $1 each and we start the bid at a penny, but someone is really desperate to get a drink, ultimately the bid can go to a point and has to stop at a point, assuming we can't borrow from the future or pool our money. And that is $1 because that's the most purchasing power any of us have. But if all of a sudden the magic printing press in the sky rains money or injects money directly into our bank account, like that would ever happen. Oh, wait. And then you end up with that money in your bank account. Now I've got $100. And if we all have $100, that same water bottle, that same 16 ounces of water, that same utility to quench X amount of thirst, nothing has grown or improved in terms of the product, its utility, its quality. Nothing has changed in terms of its demand because we still have 10 thirsty people, but the capacity to pay has changed, and that takes the bid up. So that's a very simplistic understanding of inflation. That's based on the quantity theory of money. What changes it in the real world is the Fed is able to suck that money out of the system. The governments are able to suck the money out of the system with taxation. They're able to put it into, bank reserves with the Fed. They're able to spend it or send it overseas, or they're able to suck it off, or they're able to move it from one group of people to another group of people. But ultimately, the people that it hurts the most, and this is where I totally agree with the Main Street people who decry the 1%, as much as I strive to be in the 1/10 of 1%, it's not people like you and me that they're talking about. They think they are. The people who are really doing it make them think it's us. Now, we need to tax them. But the people who are really paying the freight are all the people that are out there trying to pay for their health insurance and pay for their gasoline and pay for their clothes and their food. And when you can't siphon off key components of cost, which are primarily labor, energy, and interest expense, right? We can't take interest expense down any further than we can. Energy is already so far down. Victor, you old enough to remember Looney Tunes? Remember Looney Tunes? Okay. So you remember Yosemite Sam, big handlebar mustache? And so there's this one Looney Tunes episode where Yosemite Sam is chasing Bugs Bunny, and it's medieval England. And Bugs Bunny escapes into a castle, runs up the drawbridge, gets in the castle, pulls the drawbridge up, and Yosemite Sam is standing there where the drawbridge comes down, yelling, lower that bridge, right? And so Bugs Bunny lowers the bridge, bam, flattens Yosemite Sam, raise it up again, right? Remember Donald Trump? Lower those oil prices. Now it's even raise them up again, right? See, because the problem is when oil is too cheap, people can't produce, but nobody's concerned about production right now. So if we're not concerned about production, and oil is a key input that drives inflation down, it enriches everybody. It makes you richer. If I can produce more for less, if I can travel further for less, if I can fly my planes and do all my shipping for less, and energy being my biggest component, and petroleum being the biggest component of things like fertilizer and the cost of going into food production, on and on and on, right? If I can do all that for less, how is that bad? Well, it's bad for the same reason it was bad in the Depression, and they were ruining perfectly good food, even though people were starving, and Franklin Roosevelt was hell-bent on raising prices. Why? Because people could service their debt. It was debt. We need high energy prices because there's billions, probably trillions of dollars of debt in the oil sector. And if those bonds go bad, it always goes back to the bankers, the bonds, and the financial system, the credit markets. Now, I learned that after 2008. when credit markets fail in a credit-based economy, like Richard Duncan, who wrote The Dollar Crisis, he says our system isn't capitalism, it's creditism. It's everything's credit. And if you go back to J.P. Morgan, when he testified before the Congress, the Senate, or whatever it was back in the day, and he said, and he's the guy that bailed out everybody in 1907, which led to the formation of the Federal Reserve. He said, gold is money and nothing else. Everything else is credit. Well, gold isn't money in our system today. So guess what? It's all credit.
Today's show was part 2 of a conversation I had with Russell Gray, and you're going to be able to hear part 3 next week. I love my conversations with Russ. He's full of so much wisdom. If you haven't tuned into the Real Estate Guys radio program, you definitely want to check them out. They're at realestateguysradio.com. And in the meantime, have an awesome rest of your weekend. Go make some great things happen. I'll talk to you again tomorrow.